Good day to everyone. Welcome to our November monthly update. I can't believe how fast this year has gone. My name is Keith Duran. I'm the Senior Vice President of Business Development. We are joined, as always, by Jim Warner, who is the Head of Research and Co-Portfolio Manager. Before we get started, if you're new to the webinars, I'd just like to say that we hold these client-approved webinars for a couple of reasons, not just for the sake of giving a webinar in terms of, what's going on in the markets, like so many do, but rather how it relates to the portfolios and what the client owns. That is, because we run a concentrated portfolio of high conviction securities with a maximum of 30 positions, which are based on irrefutable themes with long-term secular tailwinds. It makes it very easy for investors to see and understand what is in their portfolio and why it's in their portfolio. So if you hear us talking about AI or the electrification or energy, then it's very easy to understand when I'm looking at my portfolio of only 30 securities or 30 positions, why that's in the portfolio. So it's really twofold. We will follow up and send you the presentation, the slide deck once it's been through compliance, and you are free to send that to your clients. So with that, before I hand it over to Jim, I would just encourage everyone to ask questions. At the bottom of the screen, you'll see a Q&A button. Please click on that, type out your question as we go through the presentation, and we'll be sure to address those after Jim's prepared remarks. So with that, I will turn it now over to you, Jim.
Great. Thanks, Keith, and thank you everyone for joining us today. Let me go ahead and share my screen as I normally do. Okay, here we go. Perfect. Okay, well, the title this month is The Economy Continues to Surprise to the Upside, but first, we need to talk about this little thing called an election that happened last night. So what we're going to not provide here is any sort of political slant. The idea here isn't to take a position one way or the other. It's just more to communicate the news. And as Keith says, whenever we look at whether it's economic information or political information, the idea is to synthesize that ultimately into how we want to position or change the portfolios. So that's really the attitude and the perspective that I'm coming from. So if I say something that offends someone, my apologies, it's unintended. That disclaimer out of the way, obviously last night Trump was declared the winner on an electoral basis. And I think the best scenario that we were telling people is that we didn't want to see unrest, right? The one thing we really didn't want to see is social unrest. And I thought the way that we could get around that was that if the electoral winner was also the popular vote winner. And it does appear that Trump is going to win the popular vote as well. Right now, there are still some outstanding states. You can see from this New York Times map that I've put in here, Nevada, New Mexico, Michigan, and Maine as of right now. But he's winning the popular vote 51% to 47.5%. And I just think that to make that a kind of conclusive win is, probably better for the country in terms of now we can sort of move forward. Now, the other thing that's happened is the Senate has flipped to Republicans. Now, there's still some outstanding races. Again, Nevada, Michigan, Wisconsin, Arizona, Pennsylvania, and Maine. How they get resolved, not really clear, but Republicans will at least have 52 seats in that chamber. So that's new. I'll talk about the House in a minute. But obviously we're getting a very strong reaction in the markets. And this is some sort of a, risk on or relief rally, whatever you want to call it. It's important to note that coming into election, there had been some de-risking in the broader market. The S&P, for example, was off almost 3% from its prior peak. So there was a little bit of room for the market to go up. Today's move is really pretty surprising. The Dow is up over 3%. The S&P is up 2%. The Russell, all the small cap indices are really ripping, up 4%. Financials seem to be the biggest sector winner. We'll go into the sectors here in a second, up nearly 5%. The VIX, which is, the measure of market volatility, has dropped like a rock, down 21%. Dollar is strong, which is kind of part of that Trump trade that I talked about a month ago, and we'll talk a little bit more about it. Bitcoin is up considerably. Recall Trump is very much in favor of Bitcoin. So you're seeing the market react there. And then we've had a huge surge in long-term interest rates. The yield on the 10-year treasury is up 4% today. And that's not I think it's moved up to close to 4.5%, but so, big moves. This knee-jerk reaction, if you can look at it, there's a couple of takeaways. You've seen obviously a spike in interest rates that I just alluded to. So real estate's performing very badly. This is also really bad for shorts. A lot of, I think, what's going on is short covering. I don't really think a lot of folks are chasing up prices right now. These have moved a lot, and this is not the kind of you don't really want to be buying into these types of big moves. But there's probably a lot of guys that are covering their shorts. The big tech social media, really specifically Meta, is having a difficult day because that's seen as sort of an anti-Trump stock. Gold's having a really tough day. I think that's more of an indication that people are sort of using proceeds from their gold to perhaps buy other things. What's generally happening is you're seeing kind of a broadening out in the market, and I think that's a trend that could continue into next year. Certainly through year end, and that would be healthy. We've talked a lot, and I'm going to spend a bunch of time on this in a minute, but we talked a lot about how narrowly focused returns have been and performance has been on just a handful of names. And now there's an opportunity for maybe some of the other industries or other stocks to get involved. So you can see that financials are up over 4%, as I mentioned, but you have energy participating, and that's been a huge laggard. Industrials are really participating in this rally today. So generally, lots of green on the screen, particularly in names that really haven't done as well as, say, the big tech names like NVIDIA. This Trump win is probably bad for certain industries that are under his microscope. I think I just mentioned social media, but also processed foods. By bringing Bobby Kennedy along on the ticket effectively and putting him in, if he's put in charge of DHS, who knows what's going to happen to a Kellogg's or a Procter and Gamble or that sort of thing. So you're seeing consumer staples down today over here in this chart on the right. And then this is very good for industries that benefit from lower regulation. That's why you're seeing this big rip in financial services. It's also very healthy for energy. We'll talk a little bit more about those specifically in a minute. And it's also really good for any companies that are engaged in a lot of M&A. So specifically today, Discover and Capital One have been engaged in merger talks for quite some time. And like a lot of other mergers, they've been delayed or negatively impacted, or it's been hard to execute given the position that the Biden administration has had on mergers. So the market is assuming, obviously, that will get sort of released, and you're seeing some of those types of names really work higher. But I think when you step back, this isn't necessarily I think, a reaction specifically to Trump, but I think it's really a reaction to the fact that markets like certainty. They don't like uncertainty. And so putting what was obviously a very contentious election behind us I think will take a bunch of volatility out of the system. And so we'll talk about where we think we're going to go here a little bit later. But I think the key here is that markets like certainty, you've gotten it in a big way, and I think in a way that hopefully brings calm to society. But we'll see. Time will tell. The House control is still unknown at this time. There's about 57 races that are undecided when I put this in just an hour ago. So it's unclear which party will control. Obviously, the stakes are significant. There's a big difference between the Republicans controlling the White House, the Senate, and the House of Representatives versus having, split chambers in Congress. So that's going to have big implications on things like the tax bill that needs to get passed next year. So if it's a red sweep, then it's carte blanche on whatever the Republicans want to do for the most part. So we'll have to. That's a really important piece of data that we don't have any idea how it's gonna turn out. All right, so take a deep breath. Now, where were we? So let's get back to talking about the economy, because as we said, elections matter, and they create some volatility in the short term, and they certainly matter longer term on policy. But by and large, markets have generally gone up no matter which party's been elected. If you look back in history. So what really is going on is the economy, right? And that's what we have to keep our eye on. So the Citi Economic Surprise Index, which is the graph on the left, tracks whether economic data is coming in better or worse than expected. And what you can see is since that bad payroll report we got at the end of July, beginning of August, it was the July payroll report that got everyone concerned. Pretty much economists from there on out have underestimated the strength in the economy. And so that upward move basically means that the economy is doing better than expected. Now, it's a great backdrop for the stock market, but it's also driving up long-term interest rates. So you've seen this pretty big surge from kind of the mid threes up to 4.25. We nearly touched 4.5% the other day. We might be there right now. The point is that we've seen these higher interest rates, but we've also seen the stock market rally pretty strongly on the back of that. And that's because, a lot of these, there's always this fear that there could be a recession right around the corner. And that's clearly, something that we keep our eye very, very close on. But you take these two data points, for example, and it looks like the U.S. economy is pretty darn strong. It grew at 2.8% in the third quarter, which is a terrific number. And you've seen the services PMI, which is effectively a measure of whether the services sector, which is 80% of the economy, whether it's growing or not. And you can see that any reading above 50 means the services sector is growing. And we actually even had a slight acceleration in September. So, this is all good for stocks and good for corporate earnings. And so the rally continues. As you can see now, this is stale, of course. This is as of the end of October. Markets are up a little bit more than what you're going to see here, but basically the S&P and the Nasdaq are up a comparable 21-ish%. And then you have the equal weight and the Dow that have been lagging, and they've been lagging, as we've talked about, because they don't have as much of an influence from the Magnificent Seven, and specifically within that, NVIDIA. So let's talk about NVIDIA. NVIDIA has been the biggest driver of the stock market this year. And so it is extremely important to have a view on NVIDIA, particularly as we go into next year. But just to put a pin on, just to put a finer remark on this, the S&P I just mentioned is up 21%. A quarter of that is coming just from NVIDIA, because NVIDIA is up 170% year to date and accounts for about 7% of the S&P 500. So it's one of the highest weighted stocks in the S&P. Only Apple has a higher weighting, but that's about 7% of the entire S&P, driving 25% of the returns. That's massive. So if you took NVIDIA out from the returns, the S&P is actually up 15%, which, if we go back to this previous slide, that's pretty much in line with the equal weight. So at any rate, the point is that people have had a very difficult time, and by people, I mean portfolio managers, owning enough NVIDIA. It's one thing to own 7% of any stock. It's another thing to own 7% of a stock that's this volatile. And what do I mean by volatile? Well, the way we measure that is through beta. And if you can see on the graph on the right, NVIDIA's beta is approaching 3, which is 3 times more than the market beta of 1. So that means it's 3 times more volatile. Now, a lot of times, what we do from a risk management standpoint, a lot of other folks do, is we beta adjust the risk in our portfolios. In other words, we take our holding position of NVIDIA and we multiply it by the beta. So in this case, let's say we have a 1.5% position, which is pretty close to what we have now of NVIDIA, and you multiply that by 3. That means that it should behave like a 4.5% position. In other words, it will move the portfolio around as if we owned 4.5 position in the S&P 500. That's essentially how to think about it. Now, if you step back and you look at it from an index standpoint, if it's a 7% weighting and it has a 3 beta, you're talking about about 20% of all of the market risk right now is in just this one stock. So from a risk management standpoint, that's anathema. That is a problem, and it's very difficult to manage around that risk because so much of the market is being moved around by this one particular stock. And as you can imagine, the first what we don't want to do is be in a situation where we own too much of something that's too risky and it starts to go down a lot, right? We want to avoid that at all costs, because what are the most important rules of investing? Well, according to Warren Buffett, and I would agree, rule number 1, never lose money. Rule number 2, never forget rule number 1. Now, it sounds trite, but really, if you look back at returns, if you have big losers, it's very hard to recover. And think about it from a wealth perspective. If you have a very bad year, think about what happened in, say, 2022, when both the bond and stock markets were down nearly 20%. It takes a while to come back from that, right? And so one of the first things you do in portfolio management and risk management is to make sure that you don't have big losses. And so I mention that because I don't think people understand the full risk they're taking in owning in the market, and implicitly then owning indirectly or directly owning NVIDIA. So very important to point that out, how important NVIDIA has been this year. Now, flipping over and thinking about fixed income, bonds, not surprisingly, and since pretty much early September or so, but definitely in October, have been taking a hit because of the higher interest rates. So that's pretty natural. If interest rates go up, bonds usually go down. And you saw the aggregate bond index drop 2.5% in October. So right now it's sitting at about up 2% for the year, which is it's positive, which is great. It's better than the last few years where we've had negative returns on the aggregate bond index, but it is a drag on portfolios. And so a lot of the questions that we have to ask ourselves is it worth having that drag, because bonds also not only provide a little bit of yield, but they also are a good hedge for the equities in portfolios. And that is actually one of the most important reasons to own bonds right now. If we get a rollover in the market, bonds should do well. And that's why they play an important role, is to dampen down portfolio volatility. Now, not everything is great in the economy. And in the last couple of weeks, we've actually gotten some data points that are, not so good. And the first one being last week's payroll number for October, rather. They grew just 12,000, and there was 100,000 expectation on the street. So they missed that pretty terribly. And that's way down, of course, from September, which was at 223,000. So there are some mitigating reasons as to why payrolls were this weak. Specifically, there were two hurricanes that impacted the number in Florida, and there was the Boeing strike of 50,000 some odd workers that also get included in that number. So but we knew about that stuff. I think the miss from there was from other sectors, and if you really dig through it, it really wasn't that great. And the only sectors that are showing hiring right now are healthcare and the government. Healthcare both have been very steady additions to payrolls over the course of this past year. But what I like to do is back out government payrolls from this number, because they tend to not really be aligned with the economy. And specifically, what's in the government number is all of the public school teachers in this country. So there's all sorts of reasons why you might have an additional workers come on board, teachers, administrators, etc. that really have nothing to do with the larger economy at hand. So so I take that out, I create this chart on the right, and you can see that once you strip out government payrolls, payrolls are actually negative. Now, that's the first time we've seen a negative in a very long time. So that's a bit of a warning signal that we're going to keep our eye very close on. Now, the other one is also labor market related, and that's job openings. And job openings, as you know, went through the roof when no one could find a worker. And now they've been normalizing over the course of the last few years, and we're basically back down to pre-pandemic levels. So not unusual. That sort of normalization, honestly, is probably expected. So that doesn't really concern us. What's starting to concern us a little bit is the job openings per unemployed worker. That ratio has fallen below 1. That means that there are fewer jobs available for unemployed workers. Now, you might say, well, that doesn't seem, that bad. Although generally speaking, we don't see this ratio go below 1 unless we're headed into a recession. And it's also really important to understand what the definition of an unemployed worker is. It means it's somebody who is actively looking for work. It's not somebody that's, sitting on the couch and saying, next month, I'll go look for a job. These are people that are out there pounding the pavement or whatever, sending out resumes, via email, what have you, actively looking for work and not finding it. So that's something that we also need to keep a close eye on. The reason is that, and I've showed this slide now many months in a row, because I think it really is the most important thing to understand going forward, which is, did the Fed keep interest rates too high for too long? Did they keep monetary policy too restrictive? And we're just now starting to see that lag effect roll into the economy negatively, right? And so this graph, which I've shown before, is the Fed funds effective rate. So that's the real-time rate that is based on the Fed funds decision of where to set them, minus inflation. And what you can see is when we get such a deviation between where rates are versus where inflation is, we've had problems in the past. This first peak was the dot-com bubble. We all know what happened after that. And this other one was right before the great financial crisis. We all know what happened after that. And so, I'm not telling you that we're going to have a crisis or anything, but I do think that this is a signal that we need to be watching the economic data very carefully as we head into next year. And the market is too. And so what you've seen over the course of the last month with all this positive economic data, putting aside, what we just saw with, payrolls last week, is essentially the market increasing their interest rate expectations, i.e. baking in fewer cuts. Now, the Fed meets on the 7th, so just, in a couple days, and the expectation is that they will cut by 25 basis points. Now, there was some noise out of one of the Fed folks this morning that maybe with this bump, we don't need to cut rates. Who knows? But right now, the market is assuming a 25 basis point cut, and then basically a very slow path back to a more neutral rate, a more neutral monetary policy, which is somewhere, in the low 3% area. This is all going to be data dependent, of course, and but the nice thing, and I'll refer to this later, and I talked about it a lot last month, is that the Fed has the markets back. As I put it last month, the Fed put is back, and they are acutely watching the labor market. And if they see a lot of weakness, they're going to cut more aggressively. So that's where we are on that. So from a portfolio strategy perspective, and I love your feedback. I don't know if this speedometer means anything to anybody, but some people like visuals. We're still leaning risk on, and the economy is strong, as I just showed you. Yeah, there's some cracks that we need to start paying attention to, but it's still generally pretty strong. Interest rates are headed lower. And then you've got a Fed that has, that is willing to cut rates as fast as they need in order to keep the economy chugging along. So you've heard the phrase, don't fight the Fed. We're not going to fight the Fed either. And then I think now with this election out of the way, it's very possible we will rally into year end. So we will have to see how that goes, but we feel pretty positive at this point. Now, 2025, these are sort of our initial views. We'll provide, kind of a more detailed look at what we think for next year, but let me get you started with something at least right now. So, one of the things, obviously, is where is NVIDIA going? That's a key consideration. My guess is it's probably not going to be as important as it was this year, but we'll have to see. But we're also very interested in the market returns from stocks not named NVIDIA. And I think potentially with today's result and the reaction you're seeing in the market, we could be in for a broadening of the market, and that would be really great. It'd be really nice to wake up in the morning and be dependent on things, stocks not named NVIDIA. Obviously, the health of the labor market is going to be a key consideration next year. And will these interest rates where they are today, will they eventually crimp economic growth? That's a very key consideration. That's also, of course, going to drive how fast the Fed cuts rates. So if we find ourselves in a situation where the economy is really starting to weaken, the Fed's going to cut pretty aggressively. Now, that may or may not be good for the market. It depends on how weak the economy is getting. But certainly, I think that if we are on this kind of steady path down to the neutral rate and we don't see any major disruptions, in the economy, that's a very good backdrop for risk assets. Key political issues. We've got a debt ceiling expiration that just is going to have to get renegotiated probably sometime in the first half of the year. There's going to be a new tax bill for sure. The one important thing I think is there won't be any increase in the corporate tax rate. I don't believe there will be. Certainly, if the House goes red and you have a clean sweep by the Republicans, you're definitely not going to get an increase in the corporate tax rate. Why is that important? Well, if you recall back in 2017, when the corporate tax rate was cut, the market rallied off that pretty hard. I think it would have done the opposite if corporate tax had been increased, which was proposed by Harris. So I think you can take that off the table. But by and large, what you're going to see is, I believe, an extension of a lot of the tax cuts that were already on the table. And so that is probably going to be supportive of the economy. Maybe not supportive about deficits, but that's a whole nother thing that we can't really estimate on. One thing we have no insight on is what Elon Musk might do as their chief cost cutter, because certainly there's a lot of costs that need to be cut. I think that's going to be a very interesting story to follow next year. I'm not sure what impact it's really going to have on the market. It's probably going to have a slight drag on GDP. But that being said, how that all shakes out with deficits and the impact that has in the bond market, it's really completely up in the air at this point. We also know that certain executive orders will be unwound, and specifically in the world of energy. Most recently, the Biden administration put a pause on approving LNG exports to non-free trade countries. Now, that hasn't had a huge impact on any of our names. Of course, that's one of our favorite themes is exporting LNG, and so it's important to us. But this particular policy doesn't really impact the company that we're invested in. But it's overall, there are going to be things like this where regulations sort of get unwound, and that should ultimately be positive for the economy. And then finally, tariffs. We have no idea whether Trump is going to enact a tariff. He's talked about a 10% across the board tariff. He's talked about higher tariffs for the Chinese. We've no idea. One question that I got recently was, what is the impact on inflation of tariffs? And the answer is, I went digging around all sorts of economic papers, and the reality is, theoretically, it depends on whether that tax is passed on to the end consumer. And so I wrote about this in my last newsletter, so I would tell you to, I'm not going to reiterate what I wrote there, so you should probably check it out. But the bottom line is that it may or may not get passed through the consumer. It probably will be slightly inflationary for a host of economic reasons. But by and large, we don't really know how it's going to pan out. And we certainly don't know how it will pan out when existing goods are experiencing deflation. So if you're trying to pass along a price hike for goods where they're already seeing, lower prices, that just seems counterintuitive. And so we really have no idea. We certainly have been very careful in avoiding owning companies that would be potentially really hit by, significant tariffs. And so to some extent, we think we're pretty insulated from this issue, but this could create some very interesting opportunities down the road, and so we'll be watching that closely. Keith, why don't I stop there and take any questions?
Sure. First of all, I think the information you had about NVIDIA was just crazy when you talk about the volatility and how much it makes up of the S&P. And if you take that out, I was just kind of fascinated by that. Just to encourage everybody to ask questions, and we do have a couple. Before I read those, I do kind of have one. I wonder how many questions might actually start this way, which is given the new administration, dot, dot, dot. You had mentioned in the opening, with less regulation. And what about financial services? Like that's something that we've stayed away from for quite some time in the portfolio. Do we
Yes.
go there or do we look at that now?
Yeah, I mean, we've owned, and depending on the portfolio, we have some financial exposure, particularly in India. The issue, as most people know, is that is kind of twofold with financials over the course of the last, call it year and a half. Remember when Silicon Valley failed, that created a huge drawdown in the banks. And one of the other things that they were facing, which ultimately led to that failure, was deposits leaving banks. So they call that deposit beta. So as interest rates were going up tremendously, people were moving their money into, things like money markets or stocks or what have you. And so that was causing a real big liquidity and funding problem for a lot of banks. And then you also had the potential credit exposure, particularly to commercial real estate. And specifically, we're talking about office and multifamily. Now, over the course of the last 18 months, with interest rates stabilizing, and actually the curve starting to steepen, this has become a much better environment for banks. So we were already starting to get, more warm on banks. There is still a couple of other issues that need to be resolved. For big banks, there's some regulatory issues like around the Basel III endgame that need to get clarified. There was still a difficult capital markets environment. And then specifically for commercial banking, there's still a lot of concern about commercial real estate. And so, for a bunch of reasons, we weren't involved from a fundamental standpoint. But this change could very positively impact sentiment on that group. So it's not something that just because we don't have a lot of exposure doesn't mean that we're not following it very, very closely. And so yeah, I mean, could we end up with a bank or more financials exposure in the next month or two? Yeah, it's possible.
Gotcha.
But yeah, it's just important to note that we do watch these things very carefully. And we just hadn't been comfortable. Also, too, the valuations had kind of gotten out of control in banks, particularly in regional banks over the course of the last 6 months, where the fundamentals just really weren't where they needed to be to support those valuations. And so we just didn't have a good entry point. But who knows? This is probably an overreaction that we're seeing today. But I do think that there are some really potentially interesting opportunities in financials that we're, monitoring very closely.
Good to know. So one question, exactly that, with the new administration, do you have any feel on the healthcare industry?
Yeah, I mean, the way we've positioned is we are very positive on biotech because we think they are going to be one of the leading winners in the application of AI. We think that should have enormous benefits for drug discovery and doing it in a very efficient manner. We also like medical devices quite a bit, broadly speaking. Just because there's a GLP-1 drug doesn't mean that people aren't going to need their hips replaced. That was kind of the trade, for the last 6 months or so. So we're still very positive on that. We don't generally traffic in the world of health insurers or hospitals. They have, the hospitals themselves have been going through this weird hangover post-COVID. And so a lot of those business models are still very much in flux. They're still restaffing because they lost a lot of nurses in particular during COVID. So we just haven't found a really compelling reason. Do I think there's going to be some massive change to the healthcare system? No, I don't think so. I think there's many other priorities in the Trump administration before they get to something like that.
Very good. I just one last question. So, given the, is there, can you talk a little bit about maybe the, again, I don't know if you want to call it the Trump trade, but the, maybe the strength of the dollar and then how that relates to gold, and if we have any, will we see any, different stance on the gold in our portfolio, which has been typically right, dude, as a hedge.
Yeah, it's been a terrific hedge, and it's really contributed incredibly to portfolios this year. And we still like gold. We don't see any real reason why. There's a whole bunch of reasons, fundamental as well as I think sentiment driven, that has driven people towards gold. In fact, there was just a meeting of the BRICS countries, and a lot of those central banks are buying up gold to try to shore up their currencies so they can have a dollar alternative, not replace the dollar, but just have the ability to transact, internationally with, whether it's renminbi or won or a rupee. But a lot of central banks are buying up gold. Yeah, I mean, I think, I wouldn't read too much into what's going on today. Again, today's a little bit of a risk on rip, and you're seeing just a lot of volatility. But the fundamentals of the economy haven't changed overnight, right? So I still think it's really appropriate in there. We still like them. We like the gold miners. Obviously there is a relationship historically with the dollar. What's been happening recently is you've seen, the surge in interest rates, which has helped, strengthen the dollar. I kind of think that trade is very long in the tooth. I don't believe that, I think the treasuries are oversold at this point. But we'll see. We'll see what happens. I mean, we'll make adjustments, of course, if we need to.
Awesome. Very good. Well, that looks like it concludes with all of the questions. So with that, I would like to thank everybody for taking time out of your day. Again, we'll send out the video and the slides once it's been through compliance. If you have any questions, by all means, feel free to reach out to us. And other than that, Jim, thanks, and we'll see you next month.
Great. Thanks. Thanks, everybody.